Good evening, everyone. On behalf of Adani Wilmar Limited, we thank you for taking out the time and joining us today. We welcome you to the virtual broker and analyst meet on the announcement of the company's forthcoming IPO. Before we begin, I would like to introduce the management and other distinguished guests who would be addressing today's gathering. From the company, we have with us Mr. Anshu Malik, CEO and Managing Director, and Mr. Shrikant Kanhere, Chief Financial Officer. Representing the BRLMs, we have Mr. Abhishek Joshi, Head of India Equity Capital Markets at Credit Suisse Securities India Private Limited, Mr. Bhavin Shukla, Adani Group Coverage, JP Morgan India Private Limited, Mr. Abhin Oswal, Associate Equity Capital Markets at Kotak Mahindra Capital Company Limited, Mr. Gautam Thaliwal, Director at BofA Securities India Limited, Mr. Raghavendra Pandey, Executive Vice President at ICICI Securities Limited, Mr. Ajay Pancholi, Head Equity Capital Markets at HDFC Bank Limited, and Mr. Soumya Gua, Vice President Advisory and Capital Markets India at BNP Paribas. Post the presentation, we will welcome questions. The questions can be typed in the Q&A panel available to you to the right of your screen if you're logging in from a desktop or laptop, or at the bottom of your screen if you're logging in from a mobile device. These questions will be read out to the management on completion of the presentation. Before we begin, we would like to take you through a short AV, which will tell us more about the journey of Adani Wilmar. May we have the AV, please?
Adani Wilmar is a joint venture between Adani Group and Wilmar International, formed in January 1999. The Adani Group is a multinational diversified business group with significant presence in sectors such as energy, power generation, airports, railways and shipping. And Wilmar Group is one of Asia's leading agri-business groups. Wilmar's integrated agri-business model encompasses the entire value chain of the agricultural commodity process in business. Adani Wilmar was formed with a vision to be a leading agri-business company committed to sustainably delivering safe, nutritious and quality products. As a result, one of India's top 100 most trusted brands, Fortune, was created, which is #1 in edible oils and touches the lives of 1 out of 3 households in India. Over the years, we have added a series of food items to our portfolio too, such as wheat flour, basmati rice, chickpeas flour, and soya chunks. Staying true to delivering quality products, we have also ventured into a range of products providing our edible oil at competitive price. And that's not it. Adani Wilmar has a significant range of institutional offerings as well. These are manufactured in our plant based at Mundra. It houses one of India's largest single locations oleochemical plant. Following the footstep of Mundra plant, we have set up 27 facilities all over India in cities like Alwar, Haldia, Vidisha, Firozpur and more. Additionally, we also provide materials for bakery, pharma, cosmetics and rubber industries. Our integrated manufacturing infrastructure enables us to share supply chain, storage facilities, distribution network, and experienced manpower among different products and reduces overall costs for processing and logistics. As of March 31, 2021, we have successfully exported our quality products to more than 50 countries. And we are constantly creating better products by researching at our Hyderabad labs. Today, Adani Wilmar is one of the fastest growing food FMCG companies in India. We converted edible oil packaging to make it recyclable. Approximately 97% of the packaging materials we used in the fiscal year 2021 are recyclable. and installed zero liquid discharge systems in effluent treatment plants to conserve water resources. Through our solar plants, we reduced the dependence on fossil fuels to mitigate carbon emissions. At Adani Wilmar, building a healthy, growing nation is our objective.
Thank you so much. That really gave us all a good insight into what Adani Wilmar is all about. I would now like to invite Mr. Abhishek Joshi from Credit Suisse Securities India Private Limited to initiate the proceedings. Over to you, sir.
Thank you. Good afternoon and welcome everyone to this broker and analyst meet for the Adani Wilmar IPO. On behalf of the management and shareholders of Adani Wilmar, as well as all the BRLMs, I welcome you to this meeting. The Adani Wilmar company is a joint venture between the Adani Group and Wilmar International of Singapore. It is one of the largest FMCG companies that has come to market recently, and we as BRLMs are extremely proud of bringing them in front of you. The company has a strong portfolio across edible oils, in which they are the market leader, with the Fortune brand being the #1 brand in this category, and also spanning essential kitchen items, including foods, rice, and pulses. The company is backed by an extremely strong management team. Mr. Anshu Malik is the CEO and MD with over 35 years of experience in the industry. And he's backed by Mr. Shrikant Kanere, who's the Chief Financial Officer with around 20 years of experience in the industry. With that, I'll take a minute to introduce you to the terms of the IPO itself. The IPO is an entirely primary offering of 3,600 crores. 50% of this will be offered to institutions, 35% to retail, and 15% to high net worth individuals. The price band is 218 to 230 rupees with a bid lot of 65 shares. The anchor date is 25th January with the main book open from 27th January to 31st January. We request your support to make this an extremely successful IPO. With that, I'll request the management to take you through the presentation.
Thank you so much, sir. I would now like to call upon the management of Adani Wilmar Limited to take us through the company, its journey, and the investor presentation. Over to you, Mr. Malik.
Thank you. We will have a short presentation of 20 minutes followed by a question and answer. So here we go. Adani Wilmar is one of the largest and also one of the fastest growing consumer businesses in India. We offer the widest range of essential kitchen commodities for the Indian consumers. Our products account for 2/3 of the kitchen spend for an average Indian household, and we reach 1/3 of all households in India. Fortune ranks amongst the top 100 most trusted brand in India. Over the past 20 years, we have transformed AWL into a food and FMCG company with a focus on becoming the most efficient supplier of the best quality and the widest range of products for the Indian kitchen. We see the journey of our company in 3 phases. The JV between Adani and Wilmar was formed in 1999, and in a short span of less than a decade, we achieved market leadership position across edible oil and industry essentials in which we were operating. From 2013, we expanded into food with a focus on staples, and in a short span of 7 years, we are now amongst the top 3 players in big categories such as wheat flour or chakki fresh atta, rice, soya chunks, and others. We at Adani Wilmar are very bullish on our prospects to become one of the biggest food FMCG company of India with national brands for all key segments. We are focused to expand into new high-value product lines such as functional oil, fortified staples, packaged and ready to eat and ready to cook food, looking at the changing consumer need. Today, our portfolio can be put into 3 verticals: edible oil, food and FMCG, and industry essentials. 73% of the revenue from oil and food comes from the branded segment. #1 in edible oil, top 3 in foods, and number 1 in industry essentials such as castor oil, stearic acid, and glycerine. If you look at our daily consumption, whether rich or poor, urban or rural, we all eat for a lunch and dinner wheat flour in terms of bread, roti, chapati, rice, pulao, biryani, pulses, besan, sugar. To cook, we need edible oil and dairy products. I have not taken into account the spices and fruits and vegetables. Basis out of the 6 daily essentials, Adani Wilmar is the only company to be in the 5 out of 6. Hence, food is the biggest business in India, and we are the biggest sellers of consumer pack edible oil. But oil is a smaller part of the overall food basket. With rice and wheat flour consumption of more than 100 million metric ton each, sugar and pulses another 25 million metric ton each, as compared to only 22 million metric ton of oil. Therefore, the potential of AWL is huge if we can be as successful in these products as we have been in edible oil. We believe we have a good chance of success based on our knowledge and expertise of the business and leveraging on our brand and distribution network to become India's biggest food FMCG company. We capture 2/3 of the kitchen bench market share within top 3 in all the branded categories in which we play, reaching 90 million or 1 out of every 3 households in India. AWL offers a very interesting and compelling investment case. Our brand Fortune is India's top brand when it comes to edible oil as well as food. We are confident of building it to become the biggest food brand in India. There are actually very few national food brands at the moment. To succeed in the essential food products, one needs to be very strong in sourcing, manufacturing, supply chain, and R&D. With our partners, Adani Wilmar have all of these. If you see how the edible oil market was in 99-2000 when we started this company, 15% was branded, 85% was loose. Consumers used to take their containers to their outlet and get the oil, the type of oil that they want. There has always been questions of adulteration or purity. But in the last 15-20 years, there has been marked shift from loose to packed. Even today, the smaller towns have pouch 100 ml, 200 ml, 500 ml branded edible oil is sold. But the same is not true in case of staples. As India's economy and population grows, the food market will grow even faster because per capita consumption will increase. With increasing income, the demand for quality food products will also grow, and therefore the potential for manufacturers of quality products like Adani Wilmar is huge. We are seeing a very clear shift towards branded product consumption driven by convenience, healthy eating trends, and rising middle class population. COVID has actually accelerated this shift from loose to packed. AWL is very focused on agri and food business because in a highly competitive and huge market like India, one has to be very focused and efficient in order to succeed. Our business model is to be involved only in agri and food business, which can share amongst themselves between the products a common trading, manufacturing facilities, brands, marketing, and distribution. We believe our people, manufacturing facilities, brand, and distribution networks are amongst the best in the industry. This strategy has enabled us success so far, and we intend to continue with the same. If you see our figures for the last 3 years, double-digit revenue growth and 20% EBITDA growth makes us one of the fastest growing consumer FMCG company in India. We are by far the largest branded edible oil, having more than 2x the market share of our next competitor. Still today, 60% of the market is fragmented with small players, local players, regional players, one oil players. There is a great opportunity to encash on this and increase our market share from 17% This has now gone up to 18.3% in March. We have a strong belief in our ability to further expand our market share due to our strong brand equity and fragmented nature of the branded edible oil market. We have holding leading positions and number one in the large categories such as soybean oil and mustard oil. These two categories contributes the largest soft oil market, and with double-digit market share in all the oils that we operate. In the recent past, we have launched multiple new categories and have reached leading positions in rice, wheat flour, soya chunks in a short duration through leveraging our brand fortune, vast distribution network, and market knowledge. AWL platform has ability to access growth as it has both agility as well as the ability to respond to the changing market requirements. We are very focused on strengthening our revenue streams through launch of value-added products, which will enable us to generate higher margins as we go forward. When you look at edible oil, almost every household in the country consumes edible oil. Rich or poor, to be in the kitchen of everyone, one has to be present in all the type of oils that the country consumes, has to be in all the pack sizes, and also has to be in different price point. We have on the top the Fortune Expert range, which works on the functional oil, worth more category. We have the main pillar, that is the Fortune, which has all the type of oils in its basket, and then the Mastige brands, which actually work as a competition to the regional players and thereby increasing the market share of the regional oil. Expanding portfolio. In the recent years, we have increasingly focused on innovative food and FMCG products by our strong in-house R&D team and necessary inputs from our parent shareholders. Our successful expansion in value-added food products demonstrates strong brand salience of Fortune and our ability to leverage our established manufacturing and distribution infrastructure. One such example is our foray into oleochemical business. Wilmar is the world's largest oleochemical player. We have palm oil refining from where we get the byproduct stearine, and which we now make oleochemicals such as stearic acid, glycerine, and soap noodles. We produce almost 9% of India's soap noodles, and from soap noodle, we have a stamping machine so that we can make our own toilet soap. This toilet soap is distributed through our existing retail channel, thereby using the distribution and the infrastructure. We have a very robust and growing conventional distribution network with over 5,500 distributors covering over 1.6 million retail outlets across the span of the country, reaching small towns and rural markets. We have an omni-channel distribution network presence across all physical stores such as DMart and Walmart, as well as the Amazon and the big baskets. In the last 2 years, we have started our own digital channel, which is Fortune Online, and now active in 25 cities. We have our own Fortune Mart, which we have started, and B2B app for our Horeca and our major retail outlets. We have a strong manufacturing infrastructure, which makes us different from our competition in terms of integrated approach towards manufacturing. Both food and oil is manufactured at the same location. We have strategically located many of the units in hinterland, such as for procurement of paddy or wheat or even chana or soybeans or mustard. And we have 10 such port-based refineries which help in imported oil coming to the ports and from there getting refined, packed and going to the market, which helps in reducing our transportation cost. AWL today has 25% of country's edible oil refining capacity. We have recently acquired a similar company in Bangladesh called as Bangladesh Edible Oil Limited, which gives us a strong position in Bangladesh through their brand Roopchanda. This is the number 2 brand there, having 25% market share and reaching 2 lakh retail outlets through 550 distributors nationwide. We have 2 factories in Bangladesh. Our strong position as edible oil importer in India, backed by Wilmar Group and long-standing relation of over 20 years with leading suppliers globally, showcase our strong raw material sourcing capabilities. Sourcing of raw material is one of the very important criteria or winning factor in this business. Because of Wilmar and because of the largest edible oil importer, we have access to much more intelligence, market intelligence. It provides us with better bargaining power, favorable commercial terms, market intelligence, and helps mitigate price risk. Looking at our industry essentials, Adani Wilmar is world's largest castor oil player. Most of the castor oil is exported to Europe, US, and also to China. We have successfully backward integrated into the industrial products such as making stearic acid and glycerine. We produce almost 32% of country's stearic acid requirement, 23% of glycerine requirement, both pharma grade and industrial grade. We have 9% soap noodles, and we make our own soap. We also provide customized product solution to our institutional customers such as Britannia, Mondelez, Nestle, Lotte, not only at India level, but at the global level. We offer a range of frying oils, bakery fat, confectionery fats, margarine to all leading food products and ice cream manufacturers in the country. We have an application lab in Hyderabad, which is specially meant for high-end fats, which are used in confectionery. When it comes to our board, we are backed by Adani Group and Wilmar Group. Adani Group's experience in domestic market and strong logistic capabilities has helped us drive our distribution infrastructure. Wilmar Group's leadership in oil business has helped us in having formidable sourcing capabilities, great market intelligence, and also creating a strong risk management framework. Wilmar is also world's largest rice processing player as well as oleochemical player. They are also the world's second largest wheat flour and sugar refiners, which helps us get technology and knowledge of both rice and wheat. High quality board with 4 independent directors with subject matter expert in sourcing, FMCG, and strategy continuously guides us. Our management team has strong proven experience in their respective domains. An average year of association of senior management is more than 10 years. This helps in a lot of stability in the organization. Our junior team is also almost more than 10 years, which helps to continue the flow of thought process from the promoters to the people below. For financial profile, I would request Shrikant to take us through.
Yeah, thank you, Mr. Malik. So before I proceed on financial profile, I'll just take a quick recap on what Mr. Malik presented so far. That Adani Wilmar today is one of the fastest growing food FMCG company of India. We have a very strong premium #1 brand Fortune to our fold, a matching distribution, very robust distribution, one of the strongest growing distribution in place. And also to match all these, we have a good manufacturing facilities in place. Now, all these 4 things needs to get reflect when it comes to the financial numbers. On top line, we are consistently growing double digit for last more than 5 years, 11% plus growth as far as the top line is concerned. As far as the EBITDA is concerned, we are growing consistently over last 3 years, 7% CAGR, last 5 years CAGR of plus of 20%. EBITDA and PAT margins are range bound between 4.5% to 5% and between 1.5% to 2%, which is a industry norm. We operate a very healthy return matrix. So when it comes to return on equity, 22% of return on equity as FY21, 11% of return on capital employed. When it comes to leverage, the gross debt sitting on the balance sheet as of close of FY21 is 1900 crore. Majority of this debt will be paid out of IPO proceeds, bringing down the leverage ratios further. We are very efficient in turning around our assets, asset turnover ratio of 8 to 9 times. And that's also the reason why, in spite of having a EBITDA margins of 4.5%, 5%, we have been able to showcase a return on equity of plus of 22%. We are consistently putting up money in capex as we are growing consistently on top line. We are not shying away from putting more capex, more capacities, more expansion to ensure that business growth is consistent and steady. Now I request again Mr. Malik to come in and talk about the growth strategy.
We believe we have the building blocks in place to continue to deliver market-leading growth. We will continue to leverage on the strengths of our promoters, our strong brand fortune, and our integrated business model to increase our profitability and competitiveness. This positions us strategically for any inorganic growth or acquisition as we go along from local or regional brands. When AWL succeeds in becoming the biggest manufacturer of the essential food products, it will have the biggest brand and distribution network in place, which can be used to launch smaller volume but higher margin products like noodles, pasta, ready to eat, ready to cook, home care products, condiments, etc., which on its own very difficult to reach to the last retailer. But when this highway of staples is ready or it goes through, it is very easy to get into this and reach the retail outlet at the least cost. To sum it up, India's evolving consumer story continues. We all agree that India is a very young country. India will continue to consume more and better food products. With the shift to branded products, Fortune being a trusted brand, AWL will strive for increasing market share. Strength of our distribution network, integrated manufacturing, sourcing, and economies of scale will support sustainable high growth and margin expansion. Strong, stable shareholders invested for the long-term success of AWL will help in growing. Thank you.
Thank you so much, sir. We will now open the floor for the Q&A session. While we have already received some questions and will be taking those questions first, a gentle reminder to all to kindly post your respective questions in the Q&A panel available. Kindly identify your name and brokerage house while sending in the questions, and we will try our level best to ensure that all questions are answered. In the interest of time, we may avoid taking any repetitive questions. Come to the first question. Sir, if you could throw some light on what are the major revenue contributors and what is the market share in major products?
Okay. As far as the volumes are concerned, we handle today roughly around 4.5 million ton, which out of which 65% is edible oil and 11% is food, that is the basic, the staples, and 24% roughly industry essentials, particularly castor oil and oleochemical products. When it comes to market share, edible oil, as I have said earlier, we are at 18.3% and showing a growth. Whereas the important is the food part, wherein only 2 years' time, today wheat flour or chakki atta, what we call, we are number 2 player. This we are because of the brand fortune and the distribution network, which is already in place. More than 65% of the distributors are all common, so they handle both food and edible oil. In rice, we are number 3. In soya nuggets, we are number 2. Sugar and besan, there is no organized agency to find out the market ranking, but we are reasonably a large player in besan. We have more than 13,500 tons capacity to produce besan in the country in 4 different geography of the country. So this is the story about the staples.
Sir, could you throw some light on the rural versus urban split as well, please?
See, as far as edible oil is concerned, roughly around 30 to 35% generally is the share of rural versus urban. Now, when I say rural, Our definition of rural is any town less than 1 lakh population is rural. But when we analyze rural, we have rural 1, 2, 3, which is basically 50,000 to 1 lakh population town, then 20,000 to 50,000 population, and less than 20,000. So we are there in less than 20,000 population town also. We have many places and many states we have distributors. Total put together, there are 2,800 distributors, which are direct distributors billed by the company directly to them, who operate in less than 1 lakh plus town, 1 lakh below town. So these are all rural distributors contributing roughly around 30-35% in case of oil, packed oil. When it comes to food staples, very surprisingly, we have found 45% of our basin sells in these smaller towns, less than 1 lakh population. Atta is around 30% and sugar is around 25%. So food average, if you can see, around 35 to 40%, little higher than edible oil, sales in smaller towns, packed, branded, in fortune.
Thank you, sir. Sir, could you throw some light on what is the CAPEX plan and what is the current interest outgo? And what will be the interest outgo post IPO?
See, the IPO, so one of the core objects of the IPO proceeds is going to be the CAPEX, which we are going to put up more integrated plants for manufacturing of various food products. As we said that the next 5 years, the strategy of company is going to be the food. As far as the interest is concerned, since we said that around 1,100 crore of long-term loan, which is sitting in the balance sheet as of close of FY21, which will get paid from the IPO proceeds. So that will certainly bring in interest in savings. So overall interest cost will go down by around 80 crores as a result of the long-term loan which are getting paid off. In our scheme of things, the interest basically consists of a working capital as well as long-term loan. As we move forward, since there won't be any long-term loan, so that interest will go off. What remains will be only a working capital interest, which is more of a dollarized funding for the company, which we utilize basis various non-funded banking lines.
Thank you, sir. So could you also throw some light on the margin breakup in the 3 different business verticals?
See, our business has to be looked upon basis and a composite level, where we say that our EBITDA margins are in the range of 4.5% to 5%. Today, as we said, we got ourselves into the food business only 2-3 years back. As far as the atta is concerned in 2018, as far as the rice is concerned in 2015. Currently, the food business is actually in a shaping up right now. So we have around 500,000 ton food portfolio right now in our basket, where Mr. Malik explained that 65% volume still comes from edible oil, 11% comes from the food, and rest comes from the industry essential. So today, food actually is an EBITDA neutral product. So whatever we are able to make at the gross margin level, we are spending it on various schemes, distribution, incentives, so that we grow this quickly, and it is growing also very fast. Our last 3 years of CAGR on food business volumes are growing plus of 30%. However, as far as the edible oil is concerned and the industry essential is concerned, the EBITDA is range bound between 4.5% to 5%.
So what are your current exports, and will these exports increase in future? Also, how does your product price compare to regional oil manufacturers?
See, as far as exports are concerned, we are primarily exporting. One is food, so edible oil, packed edible oil, atta, rice. This is one portfolio. Second portfolio is oleochemical, and the third portfolio is castor oil. Put together, the castor oil part is roughly around 2,500 crores, and then we have oleochemical, another 1,500 odd crores, and then food basket is around 400 to 500 crores, mainly rice and edible oil, and atta, also branded atta we have started exporting. So this will be our export market. As far as second question was on the regional brands.
Yes, sir. How does your product price compare to regional brands?
See, as far as regional players are concerned, in every business there are regional players. In edible oil also, as you have seen, 60% of the market is still with regional players after 20 years when all the big companies like us has been working hard to gain market share. So regional players are there, but companies like us who has a nationwide distribution coverage, has a better marketing distribution strategy in place, we have been able to make inroads into the market faster. One such example is our foray into atta. 2 years back, we just started. We felt that atta is going to be one of the biggest branded staples in the country. More than today, only 6 million ton is branded, whereas India consumes more than 40 million ton of wheat in form of atta. Now, if this grows at around 12 to 15% per annum, this business will grow very fast. Consumers are not going to stand outside a chakki and get their wheat milled. So I'm sure people would look at branded atta, good quality atta, and that is our essential requirements. In 2 years, when we started, we had the advantage of 90 warehouses in the country. We had 5,500 distributors, and we had a lot of synergy in supply chain. So we could roll out the expansion of wheat flour business. Today, we have more than 10 units where we pack wheat flour. We have common distributors, we have common supply chain system, and today we have become number 2 player. And we are growing at more than 20% per annum, 25% per annum. So for us, we see a great opportunity in becoming a very large player in wheat flour. Now, we are not there only in wheat flour, we are there in maida also, suji also. Every household requires maida, at least half a kilo. Maida is required, half a kilo besan is required. These are all essential staples inside the home. So we feel a branded maida, branded staples, branded besan, suji, rava, these are all essential. So when it comes from a house of fortune, one would be much more comfortable buying them. And as the country starts using more and more branded products, I'm sure company like Adani Wilmar will have a super edge over others. So regional players are not a worry because they have very limited span. They cannot expand fast. They have limited capital and they have limited technology. Second, Wilmar is world's second largest wheat player. They understand wheat. They know what type of technology US is bringing or China is having or any other country. So they are helping us to discuss with the suppliers the best of technology. They are the world's largest rice player. So they are giving us a lot of idea about how to select a good plant and machinery so that your broken is less, yield is high, quality is better, polishing is better, all these things. So Wilmar probably gives us a lot of technical guidance and helps us. These are the advantage that we have and possibly will keep us ahead of the competition.
Thank you, sir. Sir, could you throw some light on the contribution of value-added products and what will be the drivers for improvement in margins going ahead?
See, the value-added products, today the volumes may be less because the concentration is more to build volumes of base staples. But as we go ahead, the value-added staples will start increasing. I'll give you an example of Fortune Expert that we have started in edible oil, which is a value-added functional oil. We have just launched a new balanced fatty acid balanced oil, which is 3 oil in 1. That is the first time in India anyone has introduced 3-in-1 oil, and that we have added 5% flaxseed oil. Let me tell you, flaxseed oil is a very healthy oil and it brings in a lot of stability in fatty acid. So our daily requirement of balanced fatty acids are fulfilled by this oil, and hence we have brought this. Now, this we have been working on it, and Wilmar has been working on it, and Wilmar is selling more than 1 million tons of such type of blended oil. So they have idea about how things happen. We in India have worked on it, and hence we could introduce this oil as the first mover advantage. Now, this type of value addition will happen in flour also, will happen in rice, will happen in dal, will happen in basic staples, and then we move up the ladder in terms of value addition. Today it may be less volume, but in days to come, India will consume more and more value added functional products, because the lifestyle issues will become much and more severe. So people will look at diabetes friendly products, people will look at obesity friendly product, people will look at cholesterol friendly products. So all these things will start happening in days to come.
Thank you, sir. Sir, could you throw some light on the reason of a reduction in IPO size to 3,600 crores? Also, if you or the bankers could throw some light on the IPO price and the valuation, please.
Yeah, so when we filed the DRHP in August 21, we filed the DRHP with a size of up to 4,500 crore. And as per the regulation, a issuer is allowed to increase or reduce the IPO size up to 20%, and that's what we did. We reduced the size from 4,500 to 3,600 by taking out the 900 crore of general corporate purpose, which we earlier had envisaged, just to ensure that the IPO size is adequate, more efficient, and it helps you to run better return metrics. We have stayed on the core objects of the IPO, which we actually had filed in August, which is more to do with the capex of 1,900 crores, more to do with the repayment of term loan of 1,100 crores. And also we have kept aside 500 crore for acquisition. So besides that, what we removed is only the general corporate purpose to ensure and to make the IPO size more effective and more efficient. As far as the price band is concerned, it is between 218 to 230, which has been fixed in consultation with the BRLMs, and it is through a book building process. And after taking feedback from various investors to whom we have reached out during the roadshows.
Yeah, if I could just add on the pricing part, the company has undertaken extensive global roadshows and met high quality institutional investors, both internationally as well as domestically. As is typical in IPOs, the pricing that has been arrived at bases the feedback and participation of those investors. And we are very confident that this represents an extremely attractive price range for investors.
Thank you, sir. So while you mentioned that the focus on brands, the margins seem to have been declining or range bound. So is it due to heavy marketing and advertising expense? And if that's so, then with so many products lined up, wouldn't margins be under pressure?
See, in our business, I'll just take the first part of it, and then maybe I will hand it over to Mr. Malik to dwell more upon that. See, on our business, the top lines generally gets impacted because of the inflationary pressure. And since we have a very, very strong brand in our fold, we have been able to pass on all the inflationary pressure to the consumer. And as a result of that, generally you tend to have a situation where your revenue grows up more than the volume growth. And that's where the margin as a percentage of revenue looks going down, but that's not the underperformance. What is really we have to look at is companies been able to grow on the margins, which is commensurate with the volume growth, yes or no? I think we have been able to deliver this over last 5 years, our EBITDA CAGR of 20%, which is even more than the kind of volume growth which we have been able to register. And so therefore, margin as a percentage of revenue may not be right way of looking at it, because it may look at that it is gone down, but it's not an underperformance. Is my absolute EBITDA and margins are growing, which we have been able to showcase. Now, whether the margins would be under pressure going forward or not, I will Request Mr. Malik to dwell more on this.
Thank you, Shrikant. The inflationary pressure on edible oil, possibly we have seen the peak 3-4 months back. The edible oil prices have now started coming down. One, government has also intervened and reduced and cut the duty, which has helped us pass on the benefit to the consumers. And from the top, the market has come down reasonably. So going forward, we don't see the kind of pressure that we have seen earlier. However, we must all accept that edible oil prices amongst all the food products has been very steady and has not shown any growth in the last 5 years. So last 4-5 years, the prices have been by and large subdued. This was one of the reasons why the market all of a sudden went up, because there was a huge, the producers were not getting the remunerative price, and that could be seen. And everywhere we have seen it. So the prices went up. Now things are looking better. Now, one important thing is that all that increase in prices have led to the Indian farmers now looking at oilseed as a crop with which they can look at. So they are ready to replace it with rice, with bean and wheat and mustard. So in Rajasthan, Haryana, we have seen this year, farmers have shifted from wheat to mustard. And this year, India will produce the largest mustard crop which we have ever seen. It will cross almost 120 lakh tons from last year, 75-80 lakh tons. So almost 45-50% growth is what we are all expecting. If the weather continues the way it is today, then harvest starts in next month. So possibly we all will see a very good crop. Now, these are all happening because the farmers have started getting a remunerative price. So I think the inflationary pressures have reduced. Domestic production will go up. So that will be a win-win situation for the country, for the manufacturers like us, and for the consumers.
Thank you, sir. So which are the listed companies that you would compare yourself to? And if you could throw some light on how are you different from competition?
See, honestly, we have been scratching our head to find out whom should we look at as a competitor or as a comparison. Adani Wilmar is a very different company, let me tell you. We are there in basic staples. We are there in oleochemicals, castor oil. So you can't compare that part. So you have to break the business. But then our comparison is with us, that whether we are able to utilize our strengths. Now, what is our strength? Our strength is that when you have a largest edible oil base with you, reaching more than 1.8 million retail outlets, when you have 6,000 distributors, when you have 50 odd factories with you, when you have 90 warehouses. So all this when you have, and 5,000 vehicles going to the market daily, with more than 7,000 boys going to the retail outlet and selling. Why can't we use this strength for other products? And that is what has happened. And over the last 4 or 5 years, we have been able to add products and build the infrastructure. So today, all our factories are integrated. We don't have only edible oil plant. We are making atta there or dal there, so that 2-3 products together can go directly to the distributor. Manufacturing cost reduces. Same warehouse we use for soya bean and rice during the July to this period, October to March period, and then March onwards, when we get the wheat and mustard and chana, we transfer the warehouse to that business. So like this, we are using our resources most optimally. Factories are being run most optimally because we have such type of integrated manufacturing units and products inside the campus, same campus, and then the common distributors and all. So entire chain we are trying to use and take the advantage. So I don't know with whom to compare actually.
So what will be the effect of the increased raw material prices and its impact on EBITDA margins? And how much can it be passed on to the customers?
See, we have been able to showcase this over past more than 5 years, in typically also in FY21, that most of the inflationary pressures we have been able to deal with because of our strong brand fortune. And we have been able to pass it on to the consumer without actually impacting our bottom line. And that's why the reason in FY21, because of the COVID and all kind of restrictions, the volumes were flat, but our revenues grew by 24%. And that's basically a reflection of the fact that most of the inflationary pressure was passed on to the consumer, and the bottom line also grew. So that's also one of the reflections suggesting that while inflationary pressures were passed on to the consumer thanks to the brand, and our bottom lines are secure.
Thank you, sir. And with the disruptions such as e-commerce in India Mart, has Adani Wilmar been successful on these platforms?
Adani Wilmar is the largest seller of edible oil from any of the e-commerce platform, whether you call it Flipkart or Amazon or Big Basket. Our share is more than 30%. In the market, retail market, we may be 18.3% market share, but in e-commerce, we are a much larger player, because consumers, when they go to e-commerce sites, they look at the brand and they select the brand. So there we have a lot of advantage. As far as food products are concerned, particularly basmati rice, wheat flour, dal, and other sugar and other products, our traction from e-commerce is much better. Today, 15% of our business comes from e-commerce in case of food products, 10% from standalone modern format stores like D-Mart and Big Bazaars, and then 75% comes from the general trade. But in case of edible oil, it's different. Because edible oil is much more matured and much more widely distributed products, 90% of the business comes from general trade, 5% from modern trade, and 5% from e-commerce. But e-commerce is growing at 55%, modern trade is growing at 12%, GT is growing at around 6%. So if you look at it in edible oil, still GT is big, but the growth rate of e-commerce is the highest. We have also started our own e-commerce, Fortune Online. We have an app which we are pushing consumers to download, and we are giving a lot of benefit as items together. So if you want wheat flour and you want sugar, you get together in Fortune Online. Prices are very competitive, and there we are encouraging consumers. So we have more than 100,000 downloads last month, and consumers are coming in and we are pushing them. 25 cities we have started. We have Fortune Mart, 20 of the stores. Another 20 is coming up in the next 2-3 months. So these stores will be the place where we will interact with the consumers. We will showcase our product. We will have bakery line to showcase our bakery products. We will have testing, product testing. And then these people also, these outlets will also be our supply chain and warehouse, or what you call is as the from where we can dispatch for the online product, online demand. So these Fortune Mart and Fortune Online will be merged together so that we can push our products. Since our products are all essential commodities required every month, we have consumers coming back to us every month for a standard product portfolio.
Thank you, sir. So we understand that Fortune has a 20% plus market share in all major markets except the southern market. So how do you feel you will be consolidating your share over there?
Our foray has been from the north. So we started very strong in north, then we went to east. We were very strong in east. We are today number 1 in east. But in south, there has already been well-entrenched brands. And south market, as you know, is a very brand-centric market. Consumers are very brand-centric, and hence to shift them, to nudge them is not so easy as compared to West or North. But our way of now looking at it is that if you offer only edible oil to them, possibly they compare with any other edible oil. But when you give them an option of wheat flour, sugar, edible oil, then the retailer cannot compare with anybody, because there isn't anybody who can supply such type of 4 or 5 products together. And we are seeing some amount of advantage in it. And many of the retailers who were not willing to handle large volume of oil, at least have started handling our atta and sugar. Sugar is one entry that we are seeing is easy to enter, because sugar is a very fast moving product from the retailer shelf, and retailers are eager to keep packed sugar. If you give them even 50 paisa discount or 1 rupee discount, they just lap it up, and then you can push your edible oil where the margins are a little more higher, so you can manage it. So since you have a basket of product, so it makes our job easy. So over the last 2 years, our 8% market share in sunflower oil has now become 11%. So I am sure in days to come, we will do much better in South. We see a great opportunity. We now don't see it as a place where we cannot do. We see a great opportunity, and organization will work on it.
Thank you, sir. Sir, could you tell us more about the key drivers of the high asset turnover? And do we manufacture 100% of our products, or we outsource it? If so, could you please tell us the share of outsourcing?
See, in our business, we operate around more than 50 manufacturing locations, out of which 22 are our own manufacturing locations, and remaining 28 are basically in tolling units. So most of the share, I think more than 85% or 90% actually comes from our own manufacturing locations. Tolling are more on a food business that will in fact go off once we implement the capex which we have planned in the IPO. As far as the asset turns are concerned, as I said, we operate at a very high asset turn of 8 to 9 times, and that's the efficiency we have been able to put in the business by turning around the assets quite fast. This industry doesn't require it doesn't have a capital intensive kind of industry where you need to put a huge capital, just like a telecom or a steel industry. It needs a moderately okay capital to put in. However, the whole game is about, are you able to turn it around fast, yes or no? If you are not able to, then I have seen players who have been able to turn around only 4 or 5 times. In the similar industry, we have been able to turn it around 8 or 9 times, and that's thanks to the overall game in which today Adani Wilmar is. It's not only about the brand, it is also about the distribution, which is able to push the product to the market as quickly as possible, and therefore able to turn around the revenue more than any other company can do. And that's the reason why we are turning around more. One is, of course, the industry requires a moderate capital, capex, and of course our system is so well efficient when it comes to distribution, brand, including a manufacturing process and a supply chain through which we import. It's quite fast that we have been able to put it this kind of asset turns.
Thank you, sir. Sir, could you throw some light on how we are performing in the rural market, considering a rural slowdown at the moment?
The rural slowdown we are seeing from April onwards. Before that, honestly, rural was doing well. Last year, rural did well. But this year, the second wave of COVID, April, May, June was bad. Rural got impacted for the first time we saw. And after that, rural could not give us the type of volume that we were expecting. But normally, July, August, September is always slow in rural, because that is the time when they are busy in their agriculture work. The real business starts from October, when the harvest starts and they have money with them. So October, November, December, when there is a lot of marriages and all that. But this year, somehow, the November and December, when the real business happens, was not seen. I am confident that there will be some amount of turnaround from January onwards, because the new crop that will come from February and March also looks very good, both wheat crop and mustard. So there is going to be some good money with the agri community, and with the good market prices, good remunerative prices and MSP to them, I think they will have enough cash to come back to spending. They have been little conservative in these last 7-8 months, so the rural growth is not there. Our growth in rural for oil has been 1%, but in food we have been growing at around 12 to 15%. Normally we should have grown at 20% in food and 6 to 8% in oil. So oil has been less, but tier 2 and tier 3 towns have done much better than even bigger towns, and there we have seen a significant growth both in food, branded food, as well as in packed edible oil. So these smaller towns have done much better.
Thank you, sir. Sir, recently FMCG companies have shown flattish results. So how are you going to tackle growth, volume and margins, especially in the rural part? And by when can we expect a full growth demand?
Fortunately, we are in a product basket which consumers need every day. Recession, no recession, COVID, no COVID, we have to all eat. And our eating is what? Rice, wheat, dal, roti, and we need edible oil to cook. Edible oil prices have come down, so we are seeing demand go up. Consumption has gone up, and we can see that from December. January should be even better than December. So edible oil, from the peak, the prices have come down by almost 20% to 25%. So consumers know that these are reasonably good price, so there is no problem. Wheat, flour, sugar, all these prices are under control and there is no issues at all, and consumption is very steady. We are growing at around 25% this year in packed staples, and in edible oil we'll grow at around 6%. So we will continue to grow, and that was the growth last year. So nothing worrying we see from our side.
Thank you, sir. Sir, can you throw some light on how the volumes in oils and foods have moved with the sharp price increases put through? And did the company see any down trading to lower price bands? Or did the company take the product price increase lower than the input inflation against peers?
See, in case of edible oil, we have seen consumers down grading their brand, and we have seen that from Fortune they have shifted to our second brand Kings, but that is 3-4%. But that was only for 3 months that we have seen. From December, after the duty cut and after the prices have come down by 20%, we are seeing uptick in Fortune. January should be even better than December, as I am saying, because January is showing very, very good results so far. Now, as far as food is concerned, our entire brand is Fortune. We don't have a second brand. So there we have not seen any downgrading. We are only seeing up, and our growth is faster and higher than the market. So in food, there is no issues. In edible oil, that was a period, July, August, September, October. November onwards started going up. December was very good for Fortune brand. January is even better than December. Yes, Nikhil.
Radhika, can you please check?
Yeah, I'll just do that. Give me a minute.
Radhika, if there is a problem, I can take over.
Yes, sir. Please take over.
Sure. So we have a question on hedging policy of the company.
Yeah, so we have a very robust and strong risk management structure in place, which is approved by the board. And we strictly follow that structure, which laid down the principles of how company should hedge the commodity, currency, and the counterparty risk. We have a policy in place which has given various limits as far as the commodity is concerned. And the people who are into the buying and the sourcing at the company level, they have to maintain those limits. We seriously follow those, and there are hierarchies given, wherein if a trader goes beyond that, he has to take an approval from MD, CEO, or the chairman. As far as the currency is concerned, we are quite conservative on currency because 70% of our raw material is imports, and we don't play around with currency risk. Most of the time, we run 100% hedge ratio on the currency.
Would any of the banker would like to comment on the pricing of the issue and comparison with the listed peer group?
Let me take this up. So as mentioned earlier, there's no real direct comparable, exact apple-to-apple comparable for the company. We have deliberated on the pricing after extensive discussions with institutional investors across international and domestic. And after due deliberation, we have arrived at the price band which is just announced. That having said, this company is indeed a very, very unique play from the house of Adani and Wilmar, and this definitely, we believe, will leave a reasonable return on the table for investors who come in for from a longer term perspective as well as on an immediate perspective.
Thank you. So here's a question on margins and staples. Like, are our margins lower than compared to competition, and how do we intend to improve the margins on the staples?
Currently, as I said earlier, our food business, which is a staple food business, is today EBITDA neutral because the whole strategy of company today is to build this business to the next level. Today, we are at 500,000 tons on an overall basket of 4.5 million tons. And this business is, of course, growing at a 35% on volume. So the strategy right now, what we are applying, the whatever we earn at a gross margin level, we are spending on distribution and incentivizing the sales so that our product reach more and more market and we gain that momentum of presence across the India. So as we move forward, of course, the moment we build a food basket, which is a reasonably good, I think the margins will start coming in at the EBITDA level. And that's what the strategy in which we are working on. So there are twofold strategy. One is, of course, grow the market share. And once you reach to that market share, you can start cutting down on the spends, which you are doing to push the sales. As far as the advertisement is concerned, yes, we do spend good amount of money on the advertisement. There is a whole separate strategy on the advertisement for which I request Mr. Malik to spend little time on what kind of advertisement strategy are we adopting as far as the food business is concerned.
See, when it comes to brand building and advertising, you have a brand fortune. This is an umbrella brand. And when you have an umbrella brand, the advantage is that you don't have to start from the scratch. If we were to create a new brand for Atta, I'm sure it wouldn't have been so easy for us. Because we have a brand fortune, because it is a known brand, because we have a distribution network in place, because we have people in place, sales people in place, we only need good products, quality products to be put in, which will have a future. Now, brand building need not always be when we do it, we commingle it with one or more products. That is why most of the time you will see the brand also talking about food and oil together, and there we get a lot of advantage. More importantly, what we have done is that we are combining our products and offering it in either e-commerce or even in standalone stores. Recently, we had one deal with Reliance during October and November, wherein we had 5 kilo basmati rice and 5-liter oil we had given as a combi pack offer, and we could sell more than 5,40,000 units of each. And we couldn't supply because they had a time-bound delivery because they wanted before 5 days before Diwali. So time was less, but it was much beyond our expectation and their expectation. Consumer demand was fabulous, and more than 500,000 packs were given. Now the question is, each consumer needs such type of products. Now the brand building is such that we promoted both rice and oil together. So that is advantage. When you say Fortune combi offer, so combi offer can be this. We can always add a wheat flour in it. We can add sugar in it. Everybody wants each of these products, so consumers don't mind, and hence the brand building is easy. And going forward, you would see more and more such type of combi offers, either in modern format stores or e-commerce, or even in standalone stores. We may push as a combi offers.
Thank you, sir. Thank you, Arun, sir, for taking over. Coming back, we'll be taking the last couple of questions for this evening's session. So, what is the dealer and distributor margin? What is the gross margin in the edible oil segment? If you could throw some light on that.
See, normally in edible oil, the absolute margins work and not percentage, although they talk about 3.5%, 4%. But now that the edible oil prices are very high, distributors reduce their margin and they take around 2.5% margin. So margins in edible oil at a distributor level is less. Retailers also keep a margin of hardly 4% to 6%. Good big retailers keep around 4%, 5%, and a smaller retailer may keep 2% more. The game here is turnover. The game here is rotation. Our distributors keep 4 days to 5 days stocks maximum. They give 7 days credit to the outlet. We give them 7 days credit. They rotate it at least 2.5 times every month. So that means they have more than 30 rotations in a year. So even if they make a 1% margin every time net, they make 30%. So distributors don't look at absolute. They are always looking at turnover and faster movement of oil. So they are more happy if they can get the oil and in 3 days, 4 days, they may sell it. Again, they get it. And since we have 90 warehouses across the country, we can give them in 6 hours, 10 hours, 8 hours flat. So that is not a problem. So supply chain is very fast. In this entire game, one has to be extremely fast, extremely robust, cost efficient, and smooth, because when the demand comes from everywhere together, and we as a company has to provide that stocks as fast as possible. The faster you provide stocks, the faster he sells, the faster he comes back to you for the repeat orders, and whoever does this fast will win this race. Adani Wilmar's story has been that we have built capacities because we know that in a month, 10, 12 days will come when people will say, give me stock, retailers want, because there is a competition issue, there can be some supply chain issue, and these are all essential commodities. One has to be very robust in supply chain. So our distributors make like this. Retailers are happy because retailers make 5% is very good for them, but they don't want to make more. They want to sell at a lower price so that consumers, when they come, they know the price of edible oil, they know the price of sugar. You can't charge them more. So if they charge them less in oil, the consumers feel this outlet is very good, very honest outlet. So let me buy all my products, and then the retailer makes little more money on spices and others. So that is how this entire thing is. So the game is in rotation, the game is speed of execution.
Thank you, sir. Sir, could you elaborate a little bit more on what food products you're going to launch and what is the potential for that?
See, we have put first atta potential wise. Today it is 6 million ton, growing at around 12 to 15% per annum. More and more atta branded will go. Then we have sugar, more than 11 metric ton, 11 million ton of sugar is consumed at household, and another 10 million ton in institution. So the household consumption, only 6% is branded. So consumers are shifting towards brand. So there is a potential. We have rice, basmati rice, only 30% is branded today, in spite of big players so long in this business. Still 30% is only branded, rest is all loose. Non-basmati, particularly Sona Masuri, Kolam and other varieties, hardly 3 to 5% branded. But of late, there are some companies who have started at the local level branded rice, and we see a demand for branded rice. Similarly, besan is 10 to 12% is branded. Besan market is around 5 million ton, out of which 20% is consumer pack. And in this, there is only 10-12% branded. So there is a great opportunity to build it. The volumes are pretty large. Dal business is around 20 million ton, out of which only 3% is branded. So more and more dal in future will also go to brand. So each of these categories are very big in nature, but very small share of brand. So in future, surely there will be traction of the brand going up. This is one side of the story. Second is the other products such as ready to eat or ready to think. These are smaller in volume, but higher in margin. So they will complement the bigger ones.
Thank you so much, sir. We'll be taking the last question for this evening session. So we understand that the right way to look at margins is on a per ton basis. So has that expanded in the past 5 years?
Yeah, those are margins are certainly expanding, and that's what I said earlier on the call, that our EBITDA margins are growing more than the volume growth. So our EBITDAs are growing at 20%, which is more than the volume growth, and certainly those are expanding, and thanks to brand equity, thanks to the new products which we are launching, and also thanks to the kind of cost saving initiatives which we are putting every year, and of course our integrated structure and integrated model which deliver the products at a cheapest cost. So yes, the margins are expanding, and we hope that they will continue.
Thank you so much, sir. With that, we come to the end of the Q&A session for the Analysts and Brokers Meet. I would now like to call upon Mr. Bhavin Shukla from JP Morgan India Private Limited to give the vote of thanks. Over to you, sir.
Thank you very much. On behalf of Adani Wilmar Limited and the book runners, I want to thank you all for taking the time to listen to the company's story. Management has done a phenomenal job on the road for the last few days. As a result, we are seeing very strong interest from the investor community. And hopefully you'll see that when the anchor books open next week. We look forward to your continued support to make this a landmark offering. Thank you very much for your time.
Thank you so much. I would like to thank everyone for joining the virtual Analyst and Brokers Meet of Adani Wilmar Limited for their forthcoming IPO. While we have tried to take as many questions as possible, please feel free to reach out to us for any further queries. You could email us at ipo@adaniwilmar.in or ipo@adfactorspr.com. And we will definitely do our best to try and revert to all your queries within the next 48 hours. We look forward to your wholehearted support in making this IPO a grand success. Thank you all once again. Take care and stay safe.